Welcome to the B.F. Anderson Technical Report for January the 13th. Warren Buffett has a favorite indicator, and it's a very simple ratio of comparing the entire value of the stock market to the gross domestic product. So you can see here when he gets readings up here, which is recently, you start to get kind of rich. Things get kind of frothy. This was the .com internet bubble here. So, when it comes to valuation analysis, I kind of have to take it with a grain of salt, but I think it's something to be aware of. Also, I wanted to mention that this particular bond fund had its worst return for the start of a calendar year on record. So in other words, the interest rates are going up and it's causing these bond funds to crater. So what's going to happen, I think, is that a lot of people are going to get fed up with them and start moving money into the equity market. This is an interesting concept. Preserving your mental capital. Don't fight a losing battle only to turn gun shy when conditions are favorable. So in other words, this is all about the battle for investment survival, where you're going to cash. Look, cash is not a dirty word. A lot of people can't understand why I would go to cash like I do, but sometimes it just makes sense. Now, if you're in a major bear market, now this is going back to 07, 08, 09, and you go through something like this, by the time you get to the turn, you're so mentally exhausted that you can't do anything. So just be aware of the fact that when you do defensive things, you're basically preserving your mental capital. It's more than money. Now, the unemployment rate, I thought this would be interesting. You can see what's been going on here. I mean, with the pandemic, you got a spike all the way up to 14.5% unemployment. Now we're down to 3.9. The average historically is about 5.5. So the Federal Reserve, I think the Federal Reserve has pretty much reached the conclusion they've done their job on getting job stability going. Now they've got to tackle inflation, and the unemployment rate is actually too low. This is Tesla. I wanted to go back and kind of show you this. We got a gap up in Tesla back in 2019, and we rode the stock pretty aggressively all the way to this point here, which was a 1,700% rally. So anyway, what I'm trying to get across here is that you really want to look for these gap ups, and we're starting to see some. You can see it here. What it is, you get a spike in volume and a breakout above what we would call a sustainable base, or a good base. And so what you've got here is a breakout. You would probably buy your first buy of Tesla here, and then you get another basic move in volume and a breakout, and you would buy additional shares. Okay, let's just kind of look at the market here. As you can see here, NASDAQ hit a new high, broke down, rallied, failed to make a new high, back down again. We're going to see this over and over again. However, you can see that it held that 35-week moving average. Now, remember the rule here. If we close below the 35-week moving average for 2 consecutive weeks for both the NASDAQ and the S&P, that would be a troubling signal. Now, the mid-caps, again, we're just not seeing this market broaden out, not making new highs. The New York Stock Exchange. Now, the New York Stock Exchange is doing relatively better because as interest rates are starting to climb, we're starting to see things like banks, and as inflation becomes more of an issue, things like oil stocks. That's what's pretty much driving this index. Small caps continue to struggle. Pretty much the same story as everything else. However, I really would like to see that index improve. Here's the S&P 500. This is, again, the strongest of all the indexes, holding that 50-day. And as I said earlier, it's holding above that 35-week moving average. We don't want to go 2 weeks below it. Hadn't happened in a long time. All right, on the yield curve, we're doing 3-month Treasury bill compared to the 5-year. What's happening here is that long rates are going up faster than short rates, which is somewhat where I think the bond market is discounting inflation. In other words, if you invert, which is down here, you're discounting recession. So I don't think the market's discounting recession. I think it's just discounting inflation, and it's causing a tremendous amount of volatility in the market. Now, on the aggression index, as we mentioned last week, this is really like a hot knife through butter. It really came down through that 40-week moving average. I really would like to see this improve. However, it's just basically saying right now that you probably shouldn't be heavily invested in technology stocks. Now, on the interest rates, you can see here we've really kind of popped up here. We're at 1.73. The other thing too, oil. Oil is, I'm hearing that oil's going to 100 to 120. Wouldn't surprise me, actually. And then you got your financials, which are going with interest rates, looking pretty strong. New lows, we're seeing elevated new lows. Again, continue to see warnings, just like the Buffett indicator. Fear, greed, or the sentiment indicator, the AAII bull-bear ratio, we're back down into fear again, somewhat fear, not deep in fear, but actually is starting to improve. Now, on the put-call ratio, what I think is going to happen here is that if the market does get into a difficult situation, you're going to see these big mutual funds and institutions start hedging their portfolios with puts, and that's what's going to drive the indicator up here. But right now, it continues to be in greed. Junk bonds continue to improve. We were really getting concerned about it. Now look, it's still a downtrend, but at least we're starting to see the early signs of somewhat of an uptrend. The junk bond market is important to understand, because if everybody starts defaulting on their bonds, you can see where that would be a difficult thing for the economy. Now, volatility index, I made a change here. I think it's kind of interesting. I took rate of change for 10 days. In other words, how much has this gone up or down in the last 10 days? Well, what I'm concluding is that if the rate of change over 10 days exceeds 50%, it's basically saying that things are getting too volatile. But right now, it appears to be somewhat under control. Now, in the top 5, here we have Devon Energy. The energy stocks continue to look very promising. We're in like a nice little uptrend, holding above that 10-day moving average, getting some good buying volume in here. Devon, we own the stock. It's probably one of the better independent oil companies out there. In fact, the thing I would say to you about the oil industry, the independent oil industry, is you want to be in the Permian Basin in West Texas. And the other thing you want to have management graduate from that Mitchell School at Texas A&M, which is the case with most of these. That Mitchell School, George Mitchell invented fracking and invented horizontal drilling. Ford Motor Company, I wanted to kind of mention something here. There's something that Jesse Livermore talks about called the point of least resistance. So in other words, when you get a heavy volume day here and then you break out above that base, it's basically saying that the buyers are in control here. So the point of least resistance is when it goes up through that base on heavy volume. So you can also see here on a gap up. In other words, it's basically saying that the decision has been made. The buyers are in control. So with Ford, the stock looks good. We own it. I'm going to continue to stick with it for now. Here's Marathon Oil, same story, basically in a nice uptrend. Here is On Semiconductor. Now this is the only tech stock that I'm seeing right now that makes my list. However, you've kind of got what we call a wedge pattern here, kind of bouncing up a little bit. I think I would continue to avoid technology. This is Zim Integrated Shipping. This is an Israeli company that is involved in shipping. And they're like the 7th largest in the world. And it's kind of a quirky deal because they pay a dividend, which is something I'm just not really used to, but it's a reasonable amount. It's 20% of earnings paid on a monthly basis. And so what's happening right now is these guys are making so much money, they're getting ready this year, they're expected to pay about an 18% dividend. So the shippers are making money here, and then a lot to do with the supply chain and so forth. So if you have any questions, give me a call. Thank you very much.